I want to drill down on one of the things that you're talking about, which is equity returns. You talked about there could be a rotation in equities, meaning large versus small versus international.
Yes.
And so I wanted to get your thoughts on tactically, what are you leaning into and maybe what have you stepping away from? If you could drill down on that point for us.
Sure, and of course, every client's portfolio is going to be a little bit different. Everyone has a very different investment objective. But broadly speaking, how we would look at a portfolio, first of all, the most important thing, be diversified. Have exposure to different parts of the market. So now if we drill down, let's look at the equity side. We would be a little bit overweight small caps, low valuation, stronger earnings growth. A little bit overweight mid cap, again, strong earnings growth, better valuations. Large caps, we'd be a little bit underweight relative to our broad benchmark, but we would be overweight value. A lot of the value sectors look attractive, especially energy right now, industrials, healthcare, all very attractive value sectors. Within equities also, we like to look at a little bit of an allocation to liquid alternatives. These are the things that zig when the rest of the market is zagging. Because yes, lower market returns, sort of more modest gains, we do expect a lot of market volatility. So you want those things that do well when the markets are zigging, and you want to mitigate some of that risk. On the fixed income side, we'd be a little bit leery of high yield. High yield is very important to a portfolio, but we do think some of the valuations are extremely high right now. We'd also look at high quality fixed income. You're getting some very attractive yields, especially in those intermediate term fixed income. We think that those are very attractive. And the last point I forgot to mention, international. International, we are underweight international. We think, especially with the dollar appreciating as we've seen it this year, when you translate currency returns from international back to the US into a stronger dollar, this impacts returns not in a good way. Plus, if you look at a lot of emerging market nations where their debt is dollar-based, but their revenues are local currency based, a stronger dollar really impacts the profit margins of emerging market nations. One more thing too, given the uncertainty of the events in the Middle East, we are an oil exporter, we are an oil producer, and we are exporting to like other countries that depend on oil as importers, so Europe, Asia, emerging market nations. I'd be a little bit leery of those nations, so I would be underweight emerging markets and international.